Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving right into. U.S. stocks dropped Tuesday as investors digested the latest wave of corporate earnings and various tariff updates. The markets reacted with red at the end of the session. All major indices ended the day lower. And social app Snap reports earnings. Are the Snap skeptics accurate? We're taking a deep dive into the company's performance. And potential home buyers may have reason to be optimistic. We're looking at what mortgage rates are doing in a post-Fed period. Well, Snap shares, they're plunging right now after reporting second quarter sales shy of Wall Street's estimates as the owner of photo sharing app Snapchat dealt with a technical issue that hit revenue. Joining me now to walk through this, we've got Rohit Kulkarni, Roth Capital Partners Managing Director and Senior Research Analyst. Rohit, it is good to see you. So it looks like they report Q2 sales kind of just shy of consensus hit, Rohit. I'm seeing sales $1.345 billion. It looks like the street was at $1.35 billion. The stock actually, you can see it down hard right now in the after hours. Walk us through the results, Rohit. What do you make of the report?
Hey, thanks for having me, Josh. I think in isolation, the numbers are okay. I would call them as better than feared in analyst speak, given where Snap stock has been over the last couple of months. Having said that, if you take that along with the rest of the ad complex, Google, Meta, Reddit, even Amazon, and how the numbers of those companies have trended over the last, call it a week or so, Snap results do not look very encouraging. Growing ad revenues mid to high single digits, while almost every company so far has exceeded expectations materially and raised outlook for 3Q, given where we are in the current economic cycle. So that's what is affecting the stock sentiment here, that in isolation, the results seem to be okay, but along with the rest of the ad complex, they are not encouraging at all.
To your point, Rohit, I mean, we did see strong numbers from Alphabet, from Meta, but the stock down here, listen, it was already down nearly 15% this year. Heading into the print, it's down another quick 15% in the after hours. This after hour move, Rohit, is it justified in your opinion, or was this an overreaction?
I would think stock should be down, perhaps at least high single digits, maybe double digits. Perhaps there is a line to recovery, but regardless, these results are not as positive for the company as one would have hoped, given where we thought that for the company's stock to move higher, they probably need to have at least inline results. The EBITDA numbers missed what we were modeling for 2Q, and even the third quarter guidance is just bracketing our expectations. So all in, I think estimates would probably remain unchanged, and stock probably gets hit, driven by the sentiment when you combine it with the rest of the ad complex. So that's where we are at on Snap. I think on top of that, a smaller company growing ad revenues mid-single digits isn't something that we hope to hear consistently. So,
Rohit, I know you're neutral on Snap, right? You're on the sidelines here. What do you tell your clients would get you more constructive on this name? What would you need to see?
I think this company has been in transition over the last probably 9, maybe 12 months. The transition is happening where the company was mostly focused on brand advertising, which is top of funnel brand spend. And now they have been investing very heavily on the bottom of funnel direct response advertising. And then, in my opinion, that part of the business, which is probably 60 to 65% of revenues, that's growing solid double digits. There's a part of the business that's declining double digits. So on a blended basis, the company is still growing high single digits as such. So I think what we would like to see is how quickly can they recover that part of the business, which is brand spend, which has been declining consistently over the last 12, perhaps 15 months. They have to figure out a plan to stop that bleed, and so the overall numbers start to kind of indicate more positive momentum, as we think they have been having in probably 60 to 70% of the business right now.
On the macro, Rohit, we do have this economic data coming in. It suggests some softening, some weakening. What could that mean for the broader digital ad market, Rohit, and the key players in the market that you cover?
Typically, like when there is elevated volatility, elevated macro uncertainty, the way small and medium-sized businesses tend to react very quickly is by aggregating spend on larger platforms, which is most likely Facebook, that is Meta, and Google, and then sellers, e-commerce companies on Amazon. So that tends to hurt in the near term smaller advertising digital media companies that tend to have a greater proportion of experimental budgets. Those experimental budgets expand when we are in expanding macroeconomic situation, and they go to zero as soon as uncertainty rises. So if tariff uncertainty, if overall uncertainty into second half shopping period starts to rise, I think kind of dollars gravitate towards larger companies, and they are probably more safer bets, both for advertisers and investors.
Final question, Rohit, on Gen AI, and I'm just curious how you think about that trend, that theme impacting the digital ad market. And does that trend, Rohit, does that favor certain names more than others in this space that you cover?
So far, I would tell you, I think kind of stating the obvious, Josh, is that Meta has been kind of the poster child in executing a playbook on Gen AI over the last 9 months, much better than its peers. They have broken down every small step along the way that an advertiser takes on the platform, perhaps creating new kind of ad kind of pictures, videos, audio, putting them in front of advertisers, consumers, and putting the right ad in the front of the right person at the right time, solving that problem at scale. I think Meta has done probably one of the best jobs so far. Everybody's trying to solve that same problem. I think everybody's having a different rate of success. Reddit, Snap, Pinterest have been talking very, very publicly about it. How that evolves into next year's budgets remains to be seen, and that probably moves the needle for who solves that problem using Gen AI tools, offering them to advertisers and making them more successful with the same, making them more efficient with the same dollar spend as such.
Rohit, always great to see and to have you on the show. Thank you.
Thank you, Josh.
Stick around, much more Ask for a Trend, that's still to come. Interest rate traders are pricing in a 25 basis point rate cut in September. It's according to the CME Fed Watch. The 30-year fixed rate mortgage rate sits above 6.7% and has remained in that same narrow range for the last month. What could a possible September cut do for mortgage rates? Well, joining me now is Jeff Taylor, founder of Mphasis Digital Risk. Jeff, it is good to see you. So let's get right to that question, Jeff. If the Fed did cut in September, that would mean what for mortgage rates, Jeff?
Josh, thank you for having me today. Well, let's just take a look at what's happened over the last few days. August 1st, mortgage rates 30-year were about 6.875. Today, they're around 6.5. So we already saw 37% basis points, or 0.375 that is. And why did we see that? We saw that because the jobs report came in on an average of 35,000 jobs over the last 3 months, much lower than what people had expected. So the mortgage market tends the mortgage market moves with the bond market, as we all know. So we already saw 0.375 without a Fed rate cut. So if we did get a rate cut about 25%, then we'd be probably in around 6.25%. And I think that's when we could actually start to see maybe some refinance volume come in for people who have refinanced over 7%.
Jeff, earlier this morning, Mohamed Al-Arian, so president, of course, of Queens College, Cambridge, said a bigger rate cut could be in play in September. Take a listen.
Is it a lock for September? Yes. I think a 25 basis points cut is a lock. A 50 basis point cut is a possibility, not yet a probability, it's a possibility.
So Jeff, Mohammed, they're saying it's a possibility we get a cut by 50 in September. Let's say that happened, Jeff. What would be the effect? What would be the impact on the mortgage market?
So, let's go back and look at 2024. So before there was any rate cuts, right, you went from a 7.5 mortgage rate down to 6.17. And then we had three rate cuts covering 1%, and the mortgage market went back up to 7.4%. My point there is the mortgage market sort of moves. It does move with Fed cut, but it also sort of moves where things, inflation and other key economic data factors, such as the jobs, are also moving. So again, a Fed cut would help bring it down, but as I just said, sometimes it can be counterintuitive that after the Fed cuts, where actually the mortgage rate market goes again. So we'll see what happens. Right now, I wouldn't be surprised to see a mortgage rate somewhere in the about 6.25 in the course of the next couple of months.
Rates are important, Jeff. So is inventory. What do we see with supply right now?
So, supply is actually, I was looking at some data the other day. I haven't seen this in a long time. Right now, the price of a newly built home is 8% lower, $402,000, the medium, than existing home at $435,000. Now, a lot of that's because of builder incentives, 62% getting incentives. And the reason they're doing that is because the overall supply market is pretty healthy. Prices are starting to come down a little bit, but they're still pretty, it's pretty good supply out there. Again, if I'm looking at the market right now, I'd really be focusing on the new homes right now versus the existing market for the reasons I just said, as far as price affordability and it being a little bit cheaper.
Some of the economic data, Jeff, you've seen this that we've been getting here. It would suggest some softness. I'm just curious. You're looking at that data. You're watching those headlines. What could that mean for the housing market going forward?
So, the biggest thing is always affordability, right? So we're taking a look at if incomes or job growth is starting to slow down, when are people actually going to make that purchase, which is the biggest purchase potentially in their lifetime. What I'm seeing right now is, again, I would not be surprised to see the new homes really starting to take up as far as purchases. And, where a year and a half ago we were seeing existing homes, it was bidding at or above the current list. In the last couple of months, we're starting to see people negotiate for pretty significant discounts in housing market pretty much across the country. So if you're looking for a house, the pro tip is to be aggressive with your offers. Nobody's going to laugh you out the door. You can get a pretty decent discount. Secondly, if you're negotiating with a home builder, make sure you're asking about all the incentives you can get, because over 62% of them are giving significant incentives to get those houses sold right now.
On this last one, Jeff, you might have line of sight here. Kind of a generational question. Are younger Americans, Jeff, are they just as eager, just as excited to buy a home as they used to be? I ask because I've had some folks on the show recently kind of suggesting to me that maybe they aren't. Maybe there has been some shifts there.
It's a great question, right? So if you go back, and we had some of the millennials called 15, 20 years ago, coming out of the financial crisis, living at home, saving money, renting. We weren't seeing that first-time home buyer really jump into the market. I say right now, this generation, let's kind of put that in the last 6 to 7 years, they are looking to make that first-time purchase and get into the home market. And we're seeing that much more in volume and much more in scale than we had previously the last 10 to 12 years. So I think that a lot of the first-time home buyers are coming into the market right now. And even though affordability is an issue, they are prioritizing getting themselves a place to live as their key number one priority in financial investment.
Jeff, great to have you on the show today. Thanks so much for your time and insight. Appreciate it.
Thank you, Josh.
The housing market is in a split. In some places, like the Northeast, sellers have the upper hand in home buying, while buyers maintain their home buying power in the South. For more on the state of the housing market, let's bring in Claire Boston, Yahoo Finance senior housing reporter. Claire.
Hi, Jeff. So not Jeff, Josh.
I'll answer to anything, Claire. You can call me anything.
Same thing. It's a really interesting market right now because we are seeing in the Northeast that the housing market is still super competitive, and really sellers have the upper hand. Pretty much everywhere from Richmond all the way up to Maine is really, really heavily tilted towards sellers. But then you go to a place like the Southeast, places where they've been building a lot of homes, and it's a completely different story. Buyers are getting those really great incentives. Sellers are cutting their prices, and it's this super split market right now, and that's kind of making the national averages look a little funny.
Are there areas of the country, as you look around, Claire, that aren't as frustrating for buyers?
Generally speaking, buyers are going to have the best luck in that Southeast or that Mountain West. These are places where the home builders have been very, very active. And, as a result, they have essentially overbuilt. And generally speaking there, the buyers are going to be able to get better deals. If they buy new, you can get those interest rate buy downs. Otherwise, they can negotiate with their sellers, for those homes that have been on the market longer, maybe get them to fix some things like the roof, whatever kind of repairs might be needed.
Any signs of a shift toward buyers that you would call out?
I've been talking to realtors in some of those really hot markets like the Bostons, the New Yorks of the world, and they say that even though sellers still really have an upper hand, it's a little bit better than last year. Things are just staying on the market a little bit longer. And so that is helping buyers somewhat. That being said, it's still really expensive. Realtor.com just put out this report of where their hottest markets are, and it was places like outside of Boston, New Jersey, those kind of places. And so there it's still pretty tough for buyers.
New Jersey, interesting.
That's where you live, right?
Personal interest in New Jersey.
Yes, tough market.
Tough market. Claire, thank you. Appreciate
you.
it. Some trading day takeaways and much ahead. Stick around. Much more As for a Trend. That's still to come. Stocks closing lower as investors digest the latest wave of corporate earnings, economic data, and tariff updates. Here with the trading day takeaways, Yahoo Finance's very own Josh Schaefer. Josh.
Yeah, Josh, so one of the big takeaways from today was President Trump speaking earlier this morning on CNBC. He was talking a lot about a wide variety of things, but one of the things he talked about was the Federal Reserve, right? Of course, there's now an open spot for an official there. Also, who will replace Chair Powell is in question. So he ruled out Treasury Secretary Scott Bessent today, but he did not really opine too much more necessarily on the other two open spots, other than we're going to hear more soon. But the large theory would be he would put a dovish official in, right? So I want to take a look at how people are pricing in Fed probabilities for the full year right now. What we're looking at, Josh, this would be the odds that you only see one cut this year. That's just one 25 basis point cut. Market only pricing 11% chance now. The real debate, of course, is between 2 or 3 interest rate cuts. So economists argued that essentially what gets you to 3 instead of 2, Mohamed Al-Arian was on this morning with our friend Julie Hyman talking about this. Goldman Sachs is sort of in the same camp. To get from 2 to 3, it's probably the unemployment rate moving higher. So if the unemployment rate were to tick higher in the August jobs report, which would be out right before that September meeting, Al-Arian argued and the team at Goldman both argued maybe you get a 50 basis point cut in September again, like we saw last year. And so the Fed starts moving quicker. That's how you get to a more dovish Fed for the full year. But it's been interesting post-actual jobs report just a few days ago now. We're debating 2 or 3 rate cuts this year all of a sudden, when really the debate before was, are we even going to get one?
What economic data made your radar today?
Yeah, so it's interesting. You were talking about this earlier in the show, that ISM services data, so this is activity in the services sector, ticked lower than expected. But Neil Dutta over at Renmac did a great job of highlighting. So what we're looking at here is the 3-month moving average of 2 indexes within this release. So in white is the prices paid index. That's kind of an inflation indicator, right? If prices paid are moving higher for these companies, perhaps that means inflation is going higher. Then the employment index, what's the employment outlook look like? What do we see here, Josh? We see green going down, white going up. This is the key debate right now, right? This is, okay, if I am a hawkish Federal Reserve official that thinks we shouldn't cut that much, I'm most worried about the white line. If I'm dovish, I'm concerned about this green line and where employment's headed. What this really tells us moving forward, the data we're going to get in the next 2-3 weeks is key. That initial jobless claims we get every Thursday, how many people are filing for that, CPI coming out next week for the month of July. What we hear from those releases is going to be crucial for this.
All right, Schaefer, bullet point number 2.
I feel like really the story of the market right now remains AI, Josh, right? So we were talking throughout the show about, I'm going to flip over to our heat map here so we can find it. Palantir, PLTR, that stock rose almost 8% today. Right. And when you look at it too over a year, I mean, the run is astounding. So this stock was essentially trading hands back here at about 25 bucks a share. Mm-hmm. Closed above 170 today, Josh. Mm-hmm. And I was reading through some street commentary. It's interesting. Of course, the debate with Palantir at this point is it is very highly valued, right? It is very highly valued. It is rich valuation, rich valuation. The analysts were making that argument down here too. I remember writing about it last year. Yeah. It was too expensive when it was 25 bucks a share. Well, now they're doing over $1 billion a quarter in revenue. Stock keeps rising higher, and it just kind of reminds me of really the overall AI market we've been talking about. Keep talking if it's too expensive, if it's not too expensive. Well, for now, the stock just kind of keeps going up, Josh.
Speaking of AI, the face of AI, NVIDIA earnings coming up later this month. How important, Josh, is that report, that print for the market?
So it's important in two ways, right? So let's pull up a 3-month of NVIDIA here, and we'll take a look at the rally we've been watching. So this stock has up 56% over the last 3 months. Mm-hmm. The analysts over at Bank of America pointing out maybe you don't get a big pop off earnings because of that, right? The stock has already contributed a lot to the market, but when we think back to last week, overall CapEx spending, how companies are spending, what NVIDIA says about AI demand, when you think about what's led this rally over the last month, it's been AI, right? Over the last 3 months to 6 months, it's been a continuation of our AI story. So for NVIDIA to come out at the end of the month, ahead of those crucial economic data points, ahead of that September Federal Reserve meeting, to sort of reiterate that, that's going to be crucial, I think, as we think about the next month, 2 months for the market.
We'll be watching. Thank you, Josh. Let's take a look at what's trending now after hours. Shares of Opendoor, those are sinking after hours. The company reporting second quarter earnings and a loss per share of 4 cents versus estimates of 3.3 cents. Q2 revenue coming in at $1.6 billion. That was slightly above analyst estimates of $1.5 billion. Shares of the company recently riding that meme stock wave and surging more than 300% in the past month. The CEO, Carrie Wheeler, saying in an interview that they want to make the most of the meme stock moment. Supermicro Computer shares, they're sinking after its latest quarterly results. The company reporting a miss on earnings and net sales for the fourth quarter. While looking ahead, Supermicro providing first quarter earnings guidance of 40 cents to 52 cents per share. That did fall short of analyst estimates of 59 cents. And lastly, Toast reporting a beat on adjusted EBITDA and revenue for the second quarter. The restaurant-focused software company also lifting its full-year adjusted EBITDA outlook. However, looking at third quarter adjusted EBITDA guidance, the lower end of the company's forecast falling below Wall Street's expectations. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.